Hi guys, and welcome to our podcast. Today we're going to discuss how to use moving averages in your trading and how to combine this technique with other technical analysis tools. While some technical indicators are more popular and well known than others, moving averages are definitely one of the easiest and most useful trading tools. Moving averages, which come in various forms, weighted, arithmetic, exponential, help traders to spot trends as well as potential reversal points. Moving averages are predominantly trend tracking tools. They display the average price over a given period. Their goal is to smooth the price of the given asset, to avoid what is called the noise of the market, to better reflect market participants' sentiments at a given time. They can also be used as support and resistance levels to generate buying and selling signals. This happens if prices break through or below the moving averages, or with a moving average crossover system. As we said before, there are different types of moving averages, which place various degrees of importance on the most recent prices. It's essential for you to understand how an indicator works, so that you can adjust its parameters to suit your needs. You will then be able to adapt your trading strategy depending on the market conditions. First, we will see the main difference between two of the most used moving averages, simple moving average and exponential moving average. We will then talk about how to use moving averages as a filter and as a support resistance level. And lastly, we will describe how to use your moving average to enter and exit the market. Now, let's discuss the difference between simple moving averages to exponential moving averages. The simple moving average, SMA, is the simplest form of moving averages. You'll need to add up the closing prices of the last n periods, and you divide the result by n. It's not required to use the closing prices, but it's the most popular way to computing a simple moving average. Let's take the 20-day simple moving average, for example. Add up the closing prices from the past 20 days and divide the result by 20. In the above chart, you will notice that the 50-day simple moving average in orange is slower to react to price movements. Conversely, the 10-day simple moving average in blue more closely follows the price action. So, in a nutshell, the shorter the time period, the more accurately it will follow price movements. With the simple moving average, the weight given to each new point in the data series is the same. This is one criterion that can sometimes be limiting. Moreover, volatility spikes can distort simple moving average. Some traders think that the most recent values should have more weight, as they are more significant. To give more weight to recent data, traders can use exponential moving averages. The exponential moving average, EMA, gives more importance to the current prices. If you compare the exponential moving average, black line, to a simple moving average, orange line, you will notice that the exponential moving average lags less. This is because there is more weight to recent prices, so the exponential moving average is closer to the prices than the simple moving average. We can therefore say that the exponential moving average is more accurate. It is more accurate because it's more reactive to price changes and any new information available. You also know that prices can rapidly change in trading. It is then more important to see what most of the traders are doing right now, rather than what they were doing in the distant past. The disadvantage of using exponential moving average is that you can easily get faked out due to consolidation movements. Indeed, the exponential moving average will respond very quickly to price movements. You might think that there is a trend being formed, while it could only be a price spike. Using a simple moving average on longer time frames will help you visualize the overall trend and avoid getting into fakeouts. The downside is that the simple moving average will be smoother and slower to react to price changes. So, consequently, you might miss out on good entries to the market. It's hard to say which one is better, as most traders use them together. A simple moving average to know what the trend is, and an exponential moving average for timing their entry into the market. Let's talk now about the strategies you can use with moving average. First, you can use moving averages as a trend filter. Remember the adage, the trend is your friend. To ensure you're not trading against the trend, you can look at the price position compared to the moving average. If the price is above the moving average, this is usually a bullish trend. Conversely, if the price is below, this is likely a bearish trend. There's no point in using moving average within a range, as they will not give you any relevant information. To confirm the current trend, as well as spotting turning points, some traders display more than one moving average on their chart. They'll use one fast and one slow. Let's look back at the very first chart in this article. You will see that in a bullish trend, the fast moving average, meaning a small n, the blue line, should be above the slow moving average, higher n, the orange line. Conversely, during bearish movements, the slow moving average should be above the fast moving average. The second way is to use moving averages as support and resistance levels. Displaying moving average on a chart will also help you spot potential support and resistance levels during a trend. It also helps you anticipate changes in market participant psychology. As an example, many traders will anticipate a bounce from major moving averages if prices are going down, bullish arrows. They will also expect prices to fall back after reaching a significant resistance level, bearish arrows. Also, you can use moving averages to enter or exit positions. Moving average crossovers will help you identify points on the chart when the slow moving average passes above or below the fast moving average, and vice versa. This signals that the current trend is about to change. You can then use the areas to collect entry and exit points to open or close your trading positions. You can see on the below chart after the first crossover, the pair started to evolve in a strong upward movement. The crossover happened just after the formation of a figure called a double bottom. It has the shape of a W, as you can see on the bottom left part of the chart. In technical analysis, a double bottom describes the drop of an asset, then a rebound, then another drop to approximately the same level as the original drop, to end with another rebound. This chart pattern is a bullish pattern, signaling a reversal in the current bearish trend. Trading volume also helps to confirm the formation of such patterns, as it increases during the two rebounds. Using support and resistance levels, as well as other technical analysis tools, will help you fine-tune your analysis. This will also help you in your money and risk management. Imagine you had opened a long position after the formation of the gold crossover. You would have looked at the former resistance level, as this is where you could have placed your take profit. You could have set your stop loss around the level of the lowest point previously reached, meaning the support levels reached by the bearish movements of the double bottom. You can also see in the chart that using a crossover trading system within a range doesn't work well. It does work better in the volatile trading environment though. The most used setting for moving average crossovers are the following. 5 and 30 periods or 20 and 50 periods are mostly used for short-term investing. 20 and 100 periods, 20 and 200 periods, 50 and 200 periods. When the moving average 50 crosses up the moving average 200, it's called the golden cross. The contrary is called a death cross. 100 and 200 periods are mostly used for longer-term strategies. That's it for now. On our website, you can find more posts and podcasts. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. Do you use moving averages in your trading? If yes, are they the only tools you use, or do you use them in combination with other indicators? We would love to know your thoughts, so feel free to share them in the comments below.